Okay, so now we're on to the last section, the credit derivatives and the banking crisis. But just to show you, because at the very end of that video, I decided not to do the whole thing again, but I had noticed that this was a typo. This is FP and I hadn't got the notional in there. It has to be both sides. And that's what's coded into the spreadsheet. All right, so finally, let's talk about credit derivatives and how they precipitated the banking crisis of 2008. What is a credit derivative? Well, it's an over-the-counter contract which allows a creditor to transfer the risk of an obligor defaulting to another party, transfer risk somewhere else. An unfunded credit derivative is one where the credit protection is bought and sold between two counterparties without the protection seller having to pay anything unless default occurs. And that's what we're going to be focusing on, and most derivatives of this type are credit default swaps. There is another less common type of funded credit derivative where the protection seller, think of it like an insurance company, provides cash up front. Imagine that I get insurance and I get paid by the insurance company. That's the model for a credit-linked note, CLN. So I issue a note to the insurance company, the protection seller pays for it, and then I have to make regular coupon payments on that note. And then if a credit event occurs, as per the contract, I don't have to pay coupon payments anymore, and I will forfeit at least part of the principal as well that I got from the cash up front. So credit default swaps are what we're going to be focusing on. The buyer of a CDS makes a series of payments. This is the protection buyer, this is the protection seller. Normally, it's just like paying insurance premiums. Every so often, every month or every quarter, you pay an amount for protection. And then in this case, it could be that in this event, there is that credit event, it occurs, and so then I get the payout, just like insurance, really. Now, there are naked credit default swaps that are not allowed in the UK, but they are in the US. And this is when the seller of a CDS insures the buyer against a default of a payment in just some other reference credit risky cash flow. Doesn't have to have anything to do with the person who's bought that insurance. It's like I'm getting insurance on my neighbour's house, even though I've nothing to do with it. Well, maybe my neighbour, if that fell down, mine might. Okay, so I'm getting insurance on some unspecified house in London. There's nothing to do with me. In 2008, investment banks like Goldman Sachs, Lehman Brothers, Bank of America, they sold vast quantities of these CDSs. And these were, the credit event was linked to their own things, their own CDOs, their collateralized debt obligations. So in other words, they were betting, because they were ensuring this, that their own CDOs would not default. So we're getting a lot of money thinking, wow, people want to insure against our CDS defaulting. It's never going to happen. So yeah, sure, we'll do a CDS on that. And the people that were buying them were mainly hedge funds that had nothing to do with those CDOs. They hadn't been buying any of the tranches of the CDOs. That would have not have been a naked credit deal. It would have been a proper credit default swap because they owned the credit that might default. Anyway, the default of these CDOs caused the bankruptcy of the Lehman Brothers, which precipitated the 2008 banking crisis, and also the payouts as well, that on the CDSs, these insurance payouts were vast. But by that time, Goldman Sachs, not Lehman Brothers, but all the smart banks had sold off their CDSs to other countries. and sold off their CDOs to other countries. It was like a sort of financial bomb. They exported them via the UK offices that they have into Europe, particularly Germany, but also Spain, Italy, Portugal, Greece really got hammered by them, and also Japan. So all Goldman Sachs realized what they'd done, and Bank of America and so forth, and they quickly sold off all this toxic stuff, all these CDOs and the CDSs, so that other people took the whack and they didn't go bankrupt. But Lehman Brothers did. So to understand CDOs, we need to understand what structured products are and securitization. So a typical example of a structured product, a simple one, is an asset-backed securities. This is very like a bond, more or less. But whereas for a bond, the coupon payments come from the company cash accounts, the payments of coupons on an ABS come from income paid on the collateral, or on the assets. These underlying assets we call the collateral for the security. So, for example, it could be a pool of mortgages that is bundled into a mortgage-backed security. And people pay mortgage payments every month. And that's the income, that's the collateral for the mortgage-backed security, which is then used to pay coupons to people who buy the MBS, well, usually large institutions that buy them. So it doesn't have to be mortgages, it could be credit card payments, car loans, anything can be securitized. Typically, it's a group of smaller credits like mortgages and credit cards, lots and lots of them. They're a big group, but they're very illiquid, which you couldn't sell on otherwise. So they're loans that you wouldn't normally be able to trade in the markets, but they're traded through securitizations, and they're very risky usually. And this process called securitizations allows them to be sold on to bigger investors like institutions, hedge funds, and so forth. Because you've got a lot of different credit cards, if one defaults, another one is unlikely to, well, hopefully, they're not all going to default on payments at the same time. So each individual asset in this, each mortgage in this massive pool of thousands or tens of thousands of mortgage is just a very small fraction of the entire total. And that diversification allows the risk to be mitigated in some way. So I've already mentioned mortgage-backed securities. Well, they go back a very long way. They started in 1970. They were issued by the National Mortgage Association in the US. Ginnie Mae and Ginnie Mac, they were called. CDSs, which are real derivatives, they are over the counter, whereas ABSs, like mortgage-backed securities, are actually traded like securities. They're called securities. So they're rated just like bonds are. Remember, there are two types of securities, equities and bonds, and these are rated just like bonds by agencies such as Fitch, Moody's, S&P. Now, a collateralized debt obligation, or CDO for short, is a structured asset-backed security, which pays investors in a prescribed sequence based on the riskiness of the cash flow that the CDO collects. So investors in a CDO can choose different tranches of credit risk according to their risk appetite. The higher the risk, the higher the interest rate payment that they get. Remember, it's like a bond. So it's like the coupon on a bond. So there's a seniority in defaults. That's how it's structured. So if the cash collected in the CDO is insufficient to pay all its investors because some of the ABSs have defaulted, then the lowest, most junior tranches suffer the losses first, and the highest, most senior tranches will be the last ones to lose. So here is an illustration. of a collateralized loan obligation, a CLO. And you've got a tranche up here, which is rated AAA, AAA, down to triple B, double B, and then what they call the equity tranche. And this is increasing credit risk, and losses start at the bottom. So the equity tranche is the first group to lose any payments from defaults. So that's the most risky, they'll get the highest coupons. Whereas the AAA tranche is the last to lose payments, so they get the lowest coupons. You can think of the equity being, if you've got 1,000 mortgages, it's the first 100 mortgages that we don't know which ones they are, but whichever, one goes, two goes, three goes, and by the time 100 mortgages of defaults, equity gets nothing. It's just lost all its money. Now, you may or may not have watched The Big Short. You can find it on Netflix or anywhere. It's a very good film. It's about Michael Burry, who's quite an interesting character. He's definitely on the spectrum. And he's got this hedge fund called Scion Capital. And this film goes through how the US housing market got to be a bubble, and then it collapsed, and that led to the 2008 financial crisis. So it's an entertaining film, even though it's about the most awful crash that we are still paying for today. We're still doing all this quantitative easing, and things almost 20 years on have become so bad that we're living in the type of world we live in now. So it was really, really a bad thing that happened. And why did it happen? Well, I blame Alan Greenspan. Who's Alan Greenspan? He was the chair of the Federal Reserve for a very, very long time. And after the tech bubble collapse, so around the turn of the century, 2000, possibly before you were born, there was the growth in the late 1990s. The internet started, and we started to see all these new tech companies, Google, Apple, Microsoft, and loads of others that went bust. But those survived. Those are the big tech giants that run the world nowadays. But anyway, in the year 2000, there was a sort of crash. It wasn't like immediate, but the NASDAQ index halved over a period of a few months. And so the economy was really suffering, with all these companies going bust in the tech sector. And Alan Greenspan, to boost the economy, kept interest rates low, because if you know what, economics, fiscal policies, if you keep interest rate low, then people will borrow money to build and to start a company. And so that should stimulate the economy. But he kept interest rates really, really low for a very long time. And what did that do? Well, I mean, banks, the business of banks is to provide loans and to get interest on loans. That's the basic business of banks. And if they can't get a payback from ordinary loans, what are they going to do? If they've got an interest of only 2%, they're not making the huge profits that they normally do. So Goldman Sachs started it off and sent their salespeople out into the Midwest, where lots and lots of not very wealthy Americans were living, and sold them mortgages to buy houses or improve their houses, or to use to buy a car. And basically the credit boom, everybody was getting credit, but paying higher interest. So we had this explosion in the US housing market. So house prices went up, everybody had mortgages, even though they couldn't afford them. So these are called subprime loans because they were sold to people that really couldn't afford them. And banks started to bundle them into mortgage-backed securities, which had, after all, been around for generations. And then they tranched these into this new thing called a collateralized debt obligation. And Scion Capital didn't buy the equity tranche or any of the tranches. They bought credit default swaps. They bought a bet that these homeowners couldn't pay off their loans. So they bought bets on not only the equity tranche, but all the tranches. Even the AAA tranche was going to, it was the last 100 to default or so forth. They were also going to default. So, the premiums they were paying on these CDSs were very low, particularly for the senior tranches. So all the investors in this Scion Capital Hedge Fund were getting really, really anxious because even though the premiums weren't that large, they were being paid out, month after month after month, and there was no income coming in. He was just paying that's all he did, Michael Burry, just pay the premiums. So then, of course, he made his bets paid off when the home owners started to default. Even the AAA rated tranches lost all their market value. And that's what triggered the financial crisis. Because these investment banks, Lehman Brothers, for example, but there were other investment banks, not Goldman's, not Bank of America, but there were lots more investment banks that went bust, Bear Stearns and various others. And it's very systemic when banks start collapsing. One bank then defaults on its obligations. So Lehman's defaults on its obligations to Bear Stearns, which defaults on its obligations to another bank. And then you get this domino effect with all of these banks defaulting. So there were systemic failures in the financial system at that time, including the banks corruptly exporting these loans to other companies, even though they knew, because they collaborated with S&P and Moody's, they collaborated with them to keep the AAA rated tranches AAA, not to downgrade them, not to make them triple B, so that they could sell them on to Greece and Portugal and other countries. And of course, there was a complete failure of regulation because at that time, the Basel agreements didn't cover credit risk in that way. It just had what we call, standardized rules for covering credit risk. And it didn't model the sort of thing that happened there. Immediately afterwards, they updated the Basel Accord to include credit VaR in the calculations of credit risk capital. But we will look at that in topic 8. Okay, so that's enough for this topic. And the next topic is modeling portfolios. Bye for now.